Coffee can portfolio is an amazing investment strategy. It is a way to build huge amount of money by purchasing shares of companies and hold for several years without buying and selling actively. Let's understand this book in a very simple language. So there kis baat ki, let's get started. Chapter number 1, Mr. Talwar's Uncertain Future. According to ancient Chinese saying, the best time to plant a tree was 20 years ago. The second best time is now. There are 7 basic investment mistakes most of us make. Number 1, no clear investment plan. If you don't know where you are going, you will probably end up in the wrong place. Number 2, trading too much too often. Too many people trade too much and too often, and they do not get the benefits of the long-term investing and the sensible asset allocation. Repeated trading and modification in investment usually lead to lower returns and higher transactions cost. Number 3, lack of diversification. Different assets carry different kinds of risk and return potential. Hence, diversification in your portfolio is very important to protect yourself from stocks in a particular asset class. Number 4, high commissions and fees. Paying a higher fee on your investments over the long term can have a significant impact on your performance of your portfolio. Number 5, chasing short-term returns. Most investors chase higher returns on their investments without really knowing the risk associated with them. Number 6, timing the market. Markets do not move straight but volatile. There are indicators of various kinds that reflect the market trend at any given point of time. It doesn't mean that one can accurately determine when to enter and exit the markets. Number 7, ignoring inflations and taxes. Most investors focus on absolute returns instead of looking at real returns. To arrive at actual returns from your investments, you need to adjust and subtract the impact of inflations and taxes. Most Indians do not invest in equity at all. Those who do so in a very haphazard manner. Chapter number 2, Coffee Can Investing. Successful equity investing involves around answering 2 simple questions. Which stocks should I buy, and for how long should I hold the stocks I bought? According to Benjamin Franklin, an investment in knowledge pays the best interest. Warren Buffett explains that the kind of companies he likes to invest are companies that have a business we understand, have favorable long-term economics, have able and trustworthy management, and lastly it should have a sensible price tag. A moat that must be continuously rebuilt will eventually be no moat at all. The economic moat in the context of stock investing is something that provides a competitive advantage. The moat indicates an edge a company has over its market competitors. Long-term competitive advantage in a stable industry is what we seek in business. When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever. We are just opposite of those who hurry to sell and book profits when companies perform well, but to look closely to hang on businesses that disappoint. Peter Lynch likes such behavior to cutting the flowers and watering the weeds. People confused simplicity with ease. Warren Buffett's method was straightforward and simple. It was not simple in the sense of being easy to execute. In an environment like India, you will always have so many perceived good opportunities. If you invest in poor capital allocators, you will never get a return. Good management teams create optionality for you. In an environment like India, smart managers can create a lot of wealth. There are a limited number of companies in India where everything lines up: good business, capable and ethical management, and most importantly, you have access to the management, and such combinations do not come that often. The Coffee Can Portfolio. Kirby coined the term coffee can investing in 1984. In Old West America, people used coffee cans for storing all the important things. Then these cans were hidden beneath the mattress. The system was prevalent before the banking system was formed. In order to truly become rich, an investor has to let a sensibly constructed portfolio stay untouched for a long period of time. Historical data suggests the Coffee Can portfolio offers more than a 95% probability of generating a positive return as long as investors hold the portfolio for at least 3 years. When it comes to investing in the stock markets, greatness is defined as the ability of a company to grow while it's sustaining its moats over long periods of time. Earnings is the biggest driver of the stock market returns in the long run. Here are 4 compelling factors that go against a portfolio composed of great companies. Number 1, the power of compounding. Holding a portfolio of a stock for more than 10 years or more allows the power of compounding to play out its magic. Over the longer term, the portfolio comes to be dominated by the winning stocks, while its losing stocks keep declining to eventually become insignificant. Number 2, neutralizing the negatives of noise. Investing and holding for a long term is the most effective way of killing the noise that interferes with investment decisions. Number 3, transactions cost. By holding a portfolio of stocks for over 10 years, a fund manager resists the temptation to buy or sell in the short term. This approach reduces the transaction costs that add to the overall portfolio performance over the long term. Chapter number 3, expenses matter. Beware of little expenses. A small leak will sink a great ship. In the investment investment world, there are primarily three types of expenses that the investor knowingly or unknowingly pays for. Transaction fees, also called brokerage. It is the fee you end up paying every time you enter a transaction. Annual fees. This is more typical of funds wherein the fund manager charges an annual fee which can actually be paid on a monthly or quarterly basis as well. Hidden fees. In insurance products and structured products, it's not easy for investors to understand exactly what fees are being charged. Chapter number 4, the real estate trap. He is not a fool man who does not own a piece of land. Hebrew proverb. Real estate is a uniquely dangerous asset class for investors for the following reasons. Investment size. You can buy stock for 500 rupees, a mutual fund for 5,000, but you need to have a few lakhs with you for investing in the cheapest of properties. Liquidity. Compared to financial assets such as stocks and bonds, and even compared to physical assets such as gold, silver, real estate is a non-liquid asset class. Transaction cost. Stamp duty, registration and other transaction charges associated with buying property now exceed 10% of the cost of the property. Chapter number 5, small is beautiful. At the end of the day, small business success should just be a way station on your way to large business success. Why should a portfolio of great small caps outperform the broader large cap universe? Smaller companies have the potential to grow their profits much faster than the large companies, and secondly, as small companies grow, they are discovered by the stock market. Fundamentally, smaller companies' profits grow faster than large caps, economic growth is accelerating, and there are ample undervalued competitors. Small cap companies get discovered. More often than not, small cap firms suffer from neglect because they are not in the news and are not covered by the major brokerage houses. Chapter number 6, of patience and quality intertwine. Investors who do not have even a year of patience are likely to believe that more often than not, people lose money in equity markets. The more frequently we evaluate our portfolios, the more likely we see losses. Patience premium. A positive value patience premium implies that the longer the holding period of stock, the higher is the return generated from it for an investor. As the holding period increases from 1 year towards 3 or 5 years, volatility or risk of investors for a Sensex investor reduces significantly. Observation number 1, the shorter the holding period, the higher the quality premium. Observation number 2, a high quality portfolio with a very long holding period delivers the highest return with the lowest risk. Chapter number 7, pulling it all together. Never forget that risk, return and the cost are the three sides of the eternal triangle of investing. Essentially, what this book has highlighted is that investing for a long periods of time in the high quality portfolios with a high weightage of high quality small cap companies, while ensuring that you don't pay too much by way of fees, avoiding investment traps like real estate and gold. Warren Buffett's famous 2 rules on investing are: rule number 1, never lose money, and rule number 2, don't forget the rule number 1. The central theme in all our chapters is the power of compounding that needs time to show its effectiveness. Chapter number 8, designing your own financial plan. Some people want it to happen, some wish it would happen, others make it happen. Michael Jordan. The essential link between your investment style and your financial objective is made through financial planning. Our income usually stops at retirement, whereas expenses continue till we die. And this is the book summary of this amazing book, Coffee Can Investing. Thank you so much for watching this video. See you in the next video.